1987. If Black Monday happens again, will you be ready? Is it really necessary to meticulously study the markets, build a disciplined system, create firm rules, backtest those rules, and follow the rules religiously? The chart here tells us the answer to that question is a definitive yes. On Black Monday in 1987, the S&P 500 lost over 20% in one day. Yes, one day. On Friday, prior to Black Monday, if your portfolio was worth $5 million, on Black Monday you lost over $1 million, and at the close on Monday, your $5 million was now worth less than $4 million. If you had $250,000 on the Friday prior to Black Monday, on Black Monday you lost over $50,000, and as of the close on Monday, your portfolio was worth less than $200,000. In this video, we take a hard look at 1987 and answer the question, was technical analysis helpful in terms of calling for a reduction in stock market exposure prior to Black Monday? To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. This is a daily chart of the S&P 500 index. This is the S&P here. These are moving averages that we use to smooth out volatility. The moving averages help us stay with the trend. This is the shortest moving average or fastest moving average. The EMA 20 here uses an exponential moving average, and this is the slowest in pink here. This is your 200-day moving average using a simple moving average. This tells us that the long-term trend is bullish. Asset prices are set by the aggregate opinion of investors all over the world. So the battle between the bulls and the bears is being won by the bulls on a long-term basis here and on a short-term basis here when we have a slope that rises. This is a full bore bullish look here. I have price above all my moving averages, and the slopes of the moving averages are positive. What we'll do in this segment of the video, we'll fast forward slowly and see the observable changes in the evidence between late August and Black Monday of 1987. Then we'll compare the look of this chart the day before Black Monday to the present day in January of 2014. You can see here in late August, no alarms really going off at this point. This is pretty much a full bore bullish look. We've got a little bit of a slope turning down here in our fastest blue moving average. We're clearly in a bullish uptrend with stock prices making a series of higher highs and higher lows defined by the upward sloping green trend line. If we move ahead now to August 28th, and we're now 53 calendar days away from Black Monday, we get our first negative signal. It's nothing particularly troubling. We've got a flat blue moving average here telling us that the short-term bullish conviction is starting to wane a bit, and we have price below the blue moving average. Our uptrend is still intact, and for the most part, this is a healthy chart. If we fast forward to September 8th, now the observable evidence is beginning to become a little bit more concerning on a shorter term time frame. You can see when price goes below the moving averages and the slopes of the moving averages begin to turn down, the probability of further weakness increases. The concepts that we're presenting here are used in the CCM Market Model. The concept of staying with the trend and momentum are two big components of the model, but not the only components. Observable evidence, price below blue, the slope is turned down. Price below red, the slope has turned down. And now we have price below what appears to be a flat or flattening 50-day moving average. All kinds of yellow flags here, including a bearish break of this upward sloping trend line. Now we're in late September and we're still almost a month away from Black Monday, and the bearish and concerning observable evidence is beginning to pile up. We use the moving averages to help us discern between volatility to ignore, volatility to ignore, volatility to ignore, and volatility to respect, where the probability of bad things happening increases. When we get tight moving averages like this and we get consolidation and sideways movement, this is telling you that we have a very indecisive market on numerous time frames. We have a flat 50-day moving average here. When price is congregating around a flat 50-day moving average, it's time to pay attention. Why? Because when you get a breakout from this box in either direction, you tend to get a pretty big move. We got a breakout here, and we did indeed get a pretty big move. Our moving averages are tight here, and that tells us a big move is probably coming. Now we once again have tight moving averages and a lot of observable evidence. Price below blue, the slope is rolling over. Price below red, the slope is rolled over. Now we have price below the 50-day moving average. This is a very concerning look here. Price is below some very tight moving averages. When we break out of this area, we would expect a bigger move. It's mathematically impossible for too many bad things to happen when the stock market is in a bullish trend on a daily chart. We know there's 3 steps required to flip over from a bullish trend to a bearish trend. Step 1, we have to break a trend line. Step 2, we have to make a lower high. This is a discernible lower high relative to this high, and then you have to follow it up with a lower low. And you can see this cross is telling us here that we are getting a new lower low on a closing basis relative to this low here. So as of late September, we've now gone from a bullish uptrend on a daily chart to a bearish downtrend. We need to exceed this high here that was made in August to wipe out this bearish and concerning look. Moving to early October, the situation has improved here. Now we have price above all our moving averages, and the slopes have turned back up. This illustrates the importance of understanding that these moving averages and any technical indicator that we look at gives us a snapshot of what today looks like, and our market model uses that market profile to allocate accordingly. It's extremely important to understand this doesn't tell us anything about what tomorrow will look like. It tells us that the probabilities have improved here, but that's why we use the term probability. It doesn't tell us what will happen next, if we'll go in this direction or in this direction. When you get a tight cluster like this, a good rule of thumb is tight cluster. Wait until you get a discernible higher high after the cluster or a discernible lower low after the cluster. If you get a higher high coupled with a bullish look, that's typically a good sign. We haven't made a higher high here yet, so you would have to keep an open mind, but no doubt there's some improvement here that's observable. Moving forward till October 10th, now we have more of a concerning look. We still have these tight moving averages and price congregating around them, telling us that a larger move is probably looming. We don't know which direction that larger move will be. When price is below and the moving averages are sloping downward in a bearish manner, it tells us that the probabilities say that will continue to move in this direction on a shorter term time frame. However, we do have a bullish long-term trend in place. We have a lot of observable evidence here that's concerning still. We broke this trend line. We're still in a downtrend. We have not taken out this high here. This looks positive, but now we've pretty much erased that here. We have price below the 50-day moving average that's flat. When you have a market that's below its 50-day moving average and the 50-day moving average is flat, it's time to pay attention with an open and flexible mind. You need to have defensive game plans in place here. Your offensive coordinator ready here. We have price above a relatively flat 50-day moving average, and now we make a higher high. The faster moving averages have now crossed below the 50-day moving average. That's considered to be a bearish moving average crossover. And here we have the slopes of red and blue are down, and now we have blue crossing below red in a bearish manner. The next thing we would be looking for here that would concern us would be a close that's lower than this close here. A key element of what we're doing here and a key element of the market model is we're showing you that we do not need to predict anything. Black Monday is still more than a week away, and we have plenty of hard and observable evidence that's telling us to lighten up on our exposure to stocks. The way our market model works, the more bearish boxes that you check when you ask binary questions. Is price above blue? No. Is the slope positive? No. We can ask lots of questions about all of these moving averages. Is blue above green? No. Is red above green? No. Is the slope of the 50-day moving average positive? No. This 50-day moving average rolling over here in early October is now telling us that the battle between bullish economic conviction and bearish economic conviction is being won on an intermediate term basis now by the bears. This is very, very concerning. We have a flattish 50-day moving average that's rolling over, price below it. We have an upward sloping bullish trend line. Step one, we break that trend line. Step two, we have a discernible lower high. This high is lower than this one. We confirm the downtrend by making a lower low relative to this. A downtrend is a series of lower lows and lower highs. We're in one now on a daily chart, and we have slopes of all of these moving averages turning down. This looks quite a bit different than this. Here, blue and red are above the 50-day green. Now they're below. Here, blue is above red, telling us that the short-term trend is stronger than these intermediate-term trends. Now it's telling us that the short-term trends are weaker than the intermediate-term trend, which is breaking down. This is a clear lower low here. We've got an upward sloping and bullish 200-day moving average and a potential confrontation with that 200-day coming soon. What price does at this 200-day will tell us a lot. If it bounces off in a bullish manner, good sign. If you've taken the stance that the CCM Market Model or any probabilistic system or technical analysis in general, there's nothing you could have done in 1987. Well, the charts say otherwise here. We're clearly in a downtrend here. Now we have price that was not able to hold the 200-day moving average. A truckload of concerning things here. Established downtrend. Price below the 50-day moving average with a negative slope. One of our rules for shorting is we can never short until we get this look here. Why? If you're shorting when the slope of the 50-day moving average is positive and you're an investor, you're shorting against an established bullish trend on an intermediate term time frame. It's very, very rare for really bad things to happen in the stock market when the slope of the 50-day moving average in green is positive. Once it rolls over and price is clearly below it, alarm bells begin to go off. Slope is negative, slope is negative, slope is negative. Price is now below all of my moving averages. This is a full bore bullish look. We're getting very, very close to a full bore bearish look. The slope of this line is still up, but price is now below it. The market model would be incrementally stepping away based upon the observable bearish evidence that's piling up. It's not Black Monday yet, but boy oh boy do we have an ugly looking chart that's checking numerous bearish boxes. We've now moved to a full bore bearish look. If you look at this closely and zoom in, the slope of this has rolled over. The answers to all the questions here are all yes. Binary questions. Is price above blue? Yes. Above red? Yes. Above green? Yes. Above the 200-day pink? Yes. Are the slopes up? Yes. 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 Here, they're all no. Slope down, slope down, slope down. Slope rolling over, price below all of them. We're clearly in a bearish downtrend. This uptrend here is rear view mirror stuff in a distant memory. Now we have a market that was not able to defend the 50-day moving average in green, and it's doing absolutely nothing to try to defend the 200-day moving average here. When price slashes through a 200-day and closes near the low, about the only thing that will save this market, and it's something you have to take into consideration, is central bank intervention. To give us a visual on the trends, we have a break of a trend line. We have a discernible lower high here, and here we make a discernible lower low. This is a confirmation of a switch from a bullish uptrend to a bearish downtrend. The confirmation came before Black Monday. Our model would have taken incremental steps away starting here, and as the bearish evidence piled up, would we still have exposure to stocks here? We would, but we would have significantly less exposure and significantly less risk than we would here. The market model uses hundreds of indicators and literally asks thousands of questions each day. We're getting bearish evidence from numerous sources, not just these moving averages at this point, and by rule we would have to reduce our exposure to stocks. Welcome to Black Monday. The S&P 500 lost over 20% in one day. That's the equivalent in 2014 if the S&P 500 shed 376 points in one day. You can see why the CCM Market Model begins to step away when the observable evidence changes, and why we say it's important to keep an open mind about what happens next. We don't know what will happen here. If we assumed that price would hold at the 200-day moving average and we decided not to step away, we would have lost a lot more money on Black Monday. Would the CCM Market Model or technical analysis in general have moved us to 100% cash before Black Monday? The answer is a definitive no. We still would have lost money on Black Monday with the CCM Market Model or with this system, but we would have lost a lot less, and that's the important thing. You want to keep your capital intact so when the bottom comes, you're way ahead of everybody else. Let's shift gears now and compare this look here to 2014. One of the best ways to get better in the stock market is to study history meticulously, as we have done here, because you learn a lot about what to look for in the future. We've done that, and we've converted it into a model, which is the CCM Market Model. 1987, this is the day before Black Monday. This is the present day as of the close on Friday, January 17th, 2014. The question is, does this look anything like this? The answer is no. And what does that tell us? Does that tell us that this cannot morph into something like this? No, it doesn't tell us anything about the future. This tells us that the current profile, there's a very low probability that we will see Black Monday this Monday. It doesn't mean that the probability is zero, but you don't get stock market crashes typically from a probabilistic perspective. I want to emphasize that, from a look like this. This looks more like this or this, where the probability of good things happening continues. Slope of the blue down, now it's up. Price below the blue, now it's above the blue. Slope of red down, price below. Slope of red positive, price above. Slope of the important 50-day moving average is already rolled over before Black Monday, price well below it. The slope of the 50-day moving average in 2014 is positive, telling us that the intermediate term trend remains bullish. Price is well above the 50-day. Price is well above an upward sloping and bullish 200-day. Price is below a flat and now rolling over 200-day. Yellow and red flags all over the place here. Our concerns would increase if this chart morphs into something that looks more like this. If we get to a look like this, does it mean that a crash is coming? No, it doesn't. It just tells us that the probability of bad things happening will have increased. This doesn't happen very often, where you get moving averages falling off the table like this. That's a warning sign. It's rare for price to slash through a 200-day moving average like this, like a hot knife through butter. Price has barely acknowledged that the 200-day moving average exists here. These slopes rolling over are red flags that all occurred before Black Monday. The present day doesn't look anything like this. We'll keep an open mind, and if the evidence changes, we'll change with it, and we'll begin to reduce risk. Before Black Monday, we have a clear break of an upward sloping trend line. Do we have that now? No, we don't have that. Do we have a discernible lower high relative to a previous high? No, we really don't have anything like that right now. Do we have a discernible lower low that confirms the break of this trend line? No, we don't have that. Since there's no such thing as a perfect indicator or perfect time frame, the CCM Market Model uses numerous indicators on different time frames to improve the probability of success. We're still here in 1987. Now we're looking at a different time frame. We're looking at a weekly chart. Those of you that have watched our videos in the past know that when weekly momentum is in overbought territory, the probability of good things happening is higher. Overbought territory, good things happen. We also know that the probability of bad things happening increases when the observable evidence changes. When did the observable evidence change here? It changed almost a month before Black Monday. This is observable. It's tracked by the model. All of these changes are tracked by the model. It just doesn't ask one question. It tracks all of this and builds that into our allocation. You can also see the 22-week moving average. When the slope of your 22-week turns up, the probability of good things happening increases. When it starts to flatten out, you get concerned. And when it rolls over and prices below it, as it was here before Black Monday, the probability of bad things happening increases. The CCM Market Model is checking bearish boxes here in August, and we're starting to reduce risk, checking bearish boxes, price below, slope rolling over, preparing us for Black Monday. If a 1987 Black Monday-like event occurs in 2014, how will we use that information? The charts and indicators allow us to answer binary questions. Is price rising? Is the slope up or down? Is price above or below? We can also look at hard and unbiased data. Our submodels take that information. They allow us to get a handle on the market's current profile. The master CCM market model then compares the present day to the past and recommends a prudent exposure to risk assets such as stocks and conservative assets such as bonds. The 1987 example that we just went through shows one of many concepts used in the CCM market model, which is basically trend following. We use a lot more than those moving averages. We look at numerous indicators, risk on, risk off ratios, and indices on multiple time frames. These are the inputs for one of 5 submodels that we use. If you'd like to learn more about how the market model might possibly be able to help you protect and grow your net worth in a prudent manner, you can visit our website, follow along on Twitter, Facebook, read our blog Short Takes, or visit the Shivako Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.